All right, welcome to the Explainer. Today, we're going to break down two of the most fundamental tools in finance, stock options and index options. Now, they might sound pretty similar, but trust me, the way they work is worlds apart, and knowing that difference is absolutely crucial. So, let's say you've got a hunch. Maybe you think a specific tech company is about to take off, or maybe you're feeling a big shift coming for the entire market. The question is, how do you act on that opinion? Which tool is the right one for the job? To figure that out, we've got to start with the basics.
Okay, so before we can really compare these two, we need to make sure we're all on the same page. Let's do a quick refresher on the foundation. What exactly is an option? At its heart, it's just a contract, a simple one, really. Think of it like putting a deposit down to reserve a choice for later. The keywords there are right, but not obligation. You pay a little bit up front, that's the premium, for the power to choose. But here's the magic. You never have to make the trade if you don't want to. That flexibility, that's everything.
Yeah, and it's pretty simple when you break it down. If you've got a call option, you have the right to call the stock to you, to buy it. And if you have a put option, you have the right to put the stock onto someone else, basically to sell it. See? Call to you, put to them. Easy. Okay, with that foundation in place, let's look at the first way you can use these contracts when you're focused on just one single company. This is the world of stock options. So with a stock option, that underlying asset we were just talking about, it's something real, something tangible. It represents actual shares in a specific company. We're talking Apple, Ford, you name it. You're trading options on stuff you could literally own. And this brings us to a really crucial point. What happens if you actually exercise that option? Well, it settles with something called physical delivery. Now, don't worry, a truck isn't going to pull up to your house with a box of stock certificates. It just means the actual shares get moved from one brokerage account to another. You exercise a call and bam, 100 shares per contract land right in your account. Okay, so that's one side of the coin. But what if you don't have a strong feeling about one particular company? What if your gut is telling you something about the entire market? You think the S&P 500 is heading up, or the NASDAQ is about to dip. Well, that's where our second tool comes in, index options. And this is where things get really interesting, because it's a totally different mindset. You're not trading an option on physical shares anymore. I mean, think about it. An index like the S&P 500, it's just a number. It's a calculation, a snapshot of a whole basket of stocks. You can't actually go out and buy one S&P 500. So that brings up a pretty obvious question, right? If the thing you're trading is just a number, how do you deliver it? You can't exactly email someone the S&P 500 and call it a day. Exactly, you can't. And that's why index options have a totally different system. They're cash settled. When an index option gets exercised, zero stock changes hands. Instead, you just calculate the difference between the index's value and the option's strike price, and that difference is paid out in cold, hard cash. It's clean, it's simple, and you don't have to worry about ending up with shares from hundreds of different companies. So this whole shares versus cash thing, this is really the biggest, most important difference between the two. And it has some pretty major implications for how you'd actually use them in your strategy. You can really see the two different worlds here. On one side, with stock options, you get shares. And that means you might suddenly need the money to actually buy 100 shares of a very expensive stock. But on the other side, index options just settle up in cash, which can make managing your portfolio and your taxes a whole lot simpler. Okay, so we've covered what you get when you settle. But there's another huge difference, and that's when you're allowed to exercise your option. This is known as the option's style. So most stock options you'll see are American style. All that means is you have the freedom to exercise them anytime you want before they expire. Super flexible. But most index options are European style, and these are a bit more rigid. You can only exercise them on the very last day, on expiration day itself. So just think. American is for any time, and European is for expiration only. All right, let's pull this all together. With a stock option, you're betting on actual company shares. They get physically delivered to your account, and you can usually exercise them anytime. With an index option, you're betting on a number. It settles in cash, and you can typically only exercise on that one final day. Getting these differences straight is absolutely fundamental to using them the right way. So what's the bottom line here? Which one's better? Well, the truth is, neither one is better than the other. It all comes down to what you're trying to do. Are you making a targeted bet on one specific company, or are you playing the broader market moves?
The right tool depends entirely on your strategy, and that's exactly why understanding these details and just continuing to learn is so incredibly important. Knowledge is one of the best investments you can make, and continuous learning keeps you sharp. Subscribe to @OTSUAli on YouTube for insightful educational videos and audio podcasts.